Hello, this is Rick Cortez. I am CEO of Broadmark Asset Management, and this is the May 2024 update on the Westwood Broadmark Tactical Growth Strategy. And today, I'd like to follow up and conclude our discussion of valuation, which we began last month. I have three quick charts to show you. The first chart is the history of price-earnings multiples of the S&P 500 going back to the 1960s. And as you can see in that middle panel, there is an upward bias or an upward sweep in price-earnings multiples. They've risen over time. That may continue, and therefore we've adjusted that for that upward sweep, and that's the bottom panel on your screen. As you can see there, that gives a more optimistic to valuations. Valuations seem to be fairly valued, neither undervalued nor overvalued according to this metric. The second chart is price-earnings multiples back to the 1960s adjusted for inflation. And here there's no upward bias. And what it shows us is that inflation has taken its toll on valuations, and we are overvalued according to this measure. And the third chart is Warren Buffett's favorite valuation metric. It is stock market capitalization divided by gross domestic income. And here, as you can see in the middle panel, there is an upward sweep here in this indicator, just as there was for price-earnings multiples. So we have adjusted for this upward sweep, but even when we adjust for it, we are overvalued. Now, we are not as overvalued as we were certainly in 1929, which is on this chart, or the financial crisis or the dot-com bubble, or the recent high back in 2022. Nonetheless, we are in overvalued territory. So what do we conclude from this analysis? Well, we would have to say that while valuations can climb higher during this cycle, as suggested by that first chart I showed you, the weight of the evidence is that the market is in overvalued territory. The stock market has snapped its 5-month winning streak. And this has resulted in greatly improved investor sentiment. Monetary policy and credit conditions remain neutral until the Fed decides what it's going to do. And while momentum is still positive, it has deteriorated. So we do have a net long position in the market, but our models now suggest that we might be in for some choppy markets in the future. So let me remind you why we might be good to have in your portfolio. Number one, we have a low correlation to just about everything, particularly in down markets. Number two, we act as a shock absorber in case the correction goes deeper and longer than we think. And number three, we always lower the volatility of a portfolio. So this is Rick Cortez. Thanks so much for joining me. Please join us next month for the next update.